So let us just check whether everything is proper. Perfect. I guess everything is absolutely proper, guys. So we are good to go. We are good to start. Let me start the video. So welcome everyone to yet another amazing session on CA Final Financial Reporting, and I hope our audio is absolutely amazing, right? So let's continue with our discussion on CA Final Financial Reporting. I hope you must have revised the content whatever we have studied, as I already warned you in the previous session that you have to revise it. So before starting, whoever is watching this lecture in live mode or maybe in recorded mode, first tell me, if you are watching in recorded mode, then also you can tell me, I can feel you, I can feel you, yes or no. So tell me whether you have revised the content or not. Yes or no. Yes or no. Perfect. So you should keep this momentum going till the end of the batch, right? If you haven't done it, please get up, please do it every day. It is very important for you to score good in FR, right? And if you are doing it already, good job, guys. Okay, no problem. So let's continue with our discussion. So before starting the new content, let us again revise in the batch itself whatever we had studied yesterday, right? So let's start the revision in 3, 2, 1 and go. So initially we started the discussion of Ind AS 16, property, plant and equipment, right? The first part was definition of PP. So the definition of PP has 3 elements. Those are tangible items held for use and expected to be used for more than one period, right? Then we also discussed that bearer plant are also covered under Ind AS 16. Why? Because in case you remember, we made a chart of biological asset. So biological asset has 2 categories: living plants and animals. Living plants has 2 categories: bearer, non-bearer, right? So bearer plants are those plants which have a life of more than 1 year. For farmer, these bearer plants are like their machine only. Therefore, these bearer plants are covered under Ind AS 16, right? The bearer plants are covered under Ind AS 16, but the produce which are realized from the bearer plant is not covered under Ind AS 16. Okay, yes. Then we move forward, and then we discussed the recognition criteria. When will you record any asset? When you fulfill 2 criteria. One is future economic benefits. The first one is future economic benefits, and the second one is that cost can be measured reliably, right? The guidance aspect we will cover later during this chapter. The third point which we discussed was measurement. Measurement can be bifurcated into 2 aspects. One is initial measurement. Initial means at what value will you record on day 1, and one is subsequent measurement, that is at what value will you record on year end, right? So initially all PPs will always be recorded at perfect answer, cost, right? So what are the elements of cost? So for that we need to identify how did we acquire the asset. If we purchase the asset, then what will be the elements of cost we discussed yesterday? In that comprises of purchase prices, you have to less trade discount and rebates, then you will have to add all the non-refundable taxes, then you will also have to add all the directly attributable expenses, which will include the cost of employees, cost of site, delivery cost, installation cost, also the cost of testing. And in case if during testing if you are earning any income, you will add the net cost of testing. And if your income exceeds your expense, then in that case the excessive income will have to be deducted from the cost of the asset, right? And the following items will not be included in the cost of the asset. Also do remember, if you are using the land as a car parking site, the income from such car parking site will also be transferred to profit and loss, will not form part of the cost, right? Also, if you are getting any cash discount, such discount will not be deducted from the cost of the asset, it will be transferred to profit and loss, right? Apart from that, the important discussion which we did yesterday was the cost of decommissioning, dismantling and site restoration. So if you have decided to dismantle or restore the site, so in case you remember, we had taken one example. Let me show you that example. See, this example was there where we installed a machine, and after 5 years we had to restore the land. So this expense is restoration cost. So now this is a directly attributable expense, but the issue here is this expense is to be incurred after a period of 5 years. So will it form part of the cost? The answer is yes, because it is a directly attributable expense, but at what value? At present value. at present value. So we just did one example where we considered it at present value. The present value, for this present value we will also create a provision on day one, and because we have created the provision on present value but the payment is to be made of future value, the procedure from going from present value to future value is known as unwinding. So you have to do that as well, right? Every year you will pass an entry, interest expense to provision for decommissioning, interest expense to provision for decommissioning. Every year you will have to pass such entries. Okay, yeah. And then finally you can pass the entry for paying off. So this was whatever we had studied. Okay, someone has asked in doubt, sir, any abnormal amount wastage? If you have any abnormal wastages, that wastages should also be transferred to profit and loss. It cannot form part of the cost of the asset. Such discussion is also done when we will solve some questions under Ind AS 16. Don't worry about it. I hope this is clear to everyone, guys. Yes. So till here we had studied. Okay. Bidulog. Actually, this Bidulog is, you know what is this? There is one Bollywood actor, Jackie Shroff. So what he does is normally every actor has their own style of saying things, right? So what Jackie Shroff says, Bidu, mera bachcha hai tu. Now the meaning of this is that you are my son, or you are my daughter. Bidu, mera bachcha hai tu. Tiger Shroff's dad, Jackie Shroff. He's very funny. His mimicry is very funny. So I don't know. Yesterday I was watching any video and that just stuck in my mind. So from yesterday only I'm doing this only. Bidu log. Mera bachcha hai tu means you are my son. And also he says one more thing. Bidu log ped lagao. That means you should plant trees. Bidu ped lagao bidu. Anyways, so to continue with our discussion, now we will start discussing this point. That is deferred consideration. Now what is the meaning of this point, deferred consideration? See, ideally if you see what are the components of purchased asset, what are the components of cost if the asset is purchased, then they had asked us to refer note number 1 and 2, right? So note number 1 we already completed yesterday. Now we are moving towards note number 2, and that is deferred consideration, right? Okay, sir. Now let me try to explain this point with the help of an example. Let's say for example I went to a electronic shop, right? So you might be knowing one shop. It is named as Chroma, like you have Reliance Digital, or you might have any electronic shop. So there is one shop known as Chroma, right? So let's say this poor guy AK went to a Chroma shop, and I asked the sales personnel to show me one laptop. So he showed one laptop of HP which was worth 60,000. I told him, the king, the prince AK has arrived. Please don't show me cheap laptops. Okay. So then he came up with another laptop which was of the company Lenovo of rupees 90,000. Again I said, the king, the prince AK has arrived. Please don't show me cheap laptops. Okay. Then he showed me a laptop of Dell which was worth 1,20,000. Again I said, the prince, the king AK has arrived. Please don't show me cheap laptops. Okay. Then he came up with a expensive laptop, and that was MacBook Pro. Right. So he showed me a MacBook Pro, which is of Apple company, and it was priced at rupees 2 lakhs. So I told him that you should pack this, right? Please pack it for me. He packed it for me. I took the package and I started walking towards my home. He said, "Oh, Mr. Aakash Kandoi, wait there. Please stop." Tell me one thing. Why would he tell me to stop? See, what we did was, I told him, please pack the MacBook. He packed it for me. I took the package and I started walking towards my home, right? So he said, "Mr. Aakash Kandoi, please stop." Why did he tell me to stop? Perfect answer, because who will make the payment, sir? He will have to make the payment also, na? So, because I did not make the payment, he told me to stop. So now, what I told him was, "Oh, I forgot. Oops, sorry." Right? So I told him that I don't have money as of now. I'm a poor guy, hungry guy. I don't have money. So I told him that I will make the payment after 1 year. I will make the payment after 1 year. On saying this, he immediately told me that now the price of MacBook for you will not be 2 lakhs, it will be 2,20,000. Now tell me one thing, why is he charging me that extra 20,000? Why is he charging that extra 20,000 to me? he is charging that extra 20,000 for interest expense. Now the question arises here is, at what value will I record my PPE? At what value will I record my PPE? Right? Will I record it at 2 lakhs? Or will I record it at 2,20,000? So what the standard says is, ideally, you might feel that sir, we should record at 2,20,000, but no, you will record at 2 lakhs only. Why? Out of this 2,20,000, only 2 lakh is the amount which you are paying for the asset. Perfect answer, Supraja. Only 2 lakhs is the amount which you are paying for the asset. The incremental 20,000 which you are paying is not for the asset, it is for the extra credit period which you are demanding, right? So that 20,000 will be interest expense to be booked during the tenure of 1 year, to be booked during 1 year, to be booked as expense during 1 year, because the credit period is 1 year, right? So basically you will not add interest to the cost of the asset. Sir, but we had studied somewhere that interest is also capitalized. That was one AS which you might have studied in Inter. That was borrowing cost, AS 16. So what I'm now talking to those people who might have this query of borrowing cost. If you don't remember the provisions of borrowing cost, you can skip this part, okay? So now what borrowing cost says is, if your asset is a qualifying asset, then you can capitalize the interest. So what is the meaning of qualifying asset? In layman term, you can say that if your asset takes time to get ready for its intended use, basically if you are self-constructing asset, in that case you can capitalize the interest on such asset, right? But if you are purchasing a ready-made asset, you cannot capitalize any interest. This is covered under AS 16 borrowing cost. Also Ind AS 23 talks about these points of borrowing cost. But as of now, we will not capitalize the interest. As of now, for us, we will transfer the interest to profit and loss. Clear? The discussion of borrowing cost will be done under the Ind AS of borrowing cost, which will be covered at a later stage. Okay. Cool. So this was this point, deferred consideration. You are paying the consideration in deferment. You are deferring the consideration, right? You are not paying it immediately. So what you need to do is what we just discussed. I hope this is clear to everyone, right? So this point is done and dusted. So this was if the asset is purchased. Done. Now, what if you self-construct an asset? What if you decide to self-construct the asset? Now, what is the meaning of this point? It means that either you have two options. You can purchase the asset from the market, or you can construct it on your own. So if you are constructing the asset, the same principles which we discussed in note number 1 and 2 are applicable. See, they also say the same thing. Use same principles as that of purchased asset. See, logically, everything will be same except the fact that purchase price will not be there. There will be cost of raw materials, cost of construction will also form part of your cost of the PPE, right? In case of construction, but all other principles remain the same only. Also, there is one more point written here. We will also add borrowing cost as per Ind AS 23. Like we used to have AS 16 for borrowing cost, in Ind AS we have Ind AS 23 for borrowing cost. This discussion, what is borrowing cost? Basically, as I already said, if you are constructing an asset, in that case you can capitalize the interest. But how do we do it? When do we do it? For that, we will discuss under Ind AS 23. For that, we will discuss under Ind AS 23. Yes, Diksha, congratulations to us. Yes, that we will discuss under Ind AS 23. Okay, sir. So the discussion, apart from borrowing cost, everything is same. Okay, sir. So this was the second point. If you self-construct an asset. So what about third point? Now, third point talks about what if the asset is acquired by way of exchange. Now, what is the meaning of this point? What is the meaning of exchange? Let's say, for example, I acquired a mobile phone from you. You have an iPhone, right? So I acquired your iPhone, and in return, I did not give you cash. I gave you this calculator. Eh? Sir, what is this deal? Taking iPhone, giving calculator? Do you feel something is written on our head? Maybe. So this is known as exchange, where you do barter transactions. So for an asset, you are not giving any cash, or you are not paying through bank. You are giving another asset in exchange of your asset, right? So in that case, how will the accounting be done? So for this, we will write an example in the notebook. So you will say, notebook example. Notebook example, right? Let's start discussing this. So give a new heading in your notes. Exchange of assets. Exchange of assets. Right? Let's say, for example, there is one company, AK Limited. So what AK Limited did was, it acquired an asset. What was the asset acquired? We can also call this as incoming asset. So let's say I acquired iPhone 14 from you, one of you guys. I acquired an iPhone 14, and in return, I gave you one asset, that is asset given up. We can call this as outgoing asset. Now what did I give in return? I gave you one calculator. Sir, is this deal really fair? The answer is yes. I'll tell you why. This calculator has a special feature. If you see, it has a sensor here. So if you just show the question to this calculator, it will automatically calculate the answer. Now tell me, is this worth it? The answer is of course yes. So for this iPhone 14, of course any CA student will agree for this. Also, you know the best part about this, it also gives theory answers. So if you show the question of audit, it will show the theory answer here. Nonsense. Anyways, okay. So the given up asset was calculator. The given up asset was calculator. Now, how? Yes, sir, worth it, lol. Okay. So now, how do we account for this, right? So there is one incoming asset, there is one outgoing asset. Okay. Let me give you some further details as well. Your notes are superb. You're superb. You are superb. Your notes are awesome. Have special feature. Thank you so much, Dharmik Dhanesha. Thank you so much. Yeah. So please write down some further information as well. Let's say the fair value of iPhone was 1 lakh. And for calculator also we have some information given as the fair value of this calculator is 90,000. And the carrying amount is, let's say, 60,000. The carrying amount is, let's say, 60,000. Now, how will we account for this in the books of AK Limited? So initially just try to pass one journal entry for this. So what entry we will pass for this? So you will say iPhone is an incoming asset. So you will say iPhone 14 account debit. 2, which is the outgoing asset calculator. So you will say 2 calculator account. Okay. Now I had told you one thing. Whatever is the outgoing asset, it will always go out at what amount? It will always go out at carrying amount, in case you remember this point, right? So the outgoing asset is yes, Nishita. So the outgoing asset will go out at carrying amount, right? So you will say at carrying amount, that will be 60,000. Now the question which arises is, at what value we will record the incoming asset? You cannot say that you will record at 60,000. That is not the provision, right? So the provision which you are going to discuss is for the incoming asset. At what value do we record the incoming asset? So write down the provision here. So we have 3 preferences here, right? Just write it down first and then we will discuss about it. Okay. First preference will be given to fair value of asset. First preference will be given to fair value of asset given up plus cash paid if any. So what is this cash paid if any? We will discuss. Second preference is fair value of asset. Second preference is fair value of asset acquired. So if you have fair value of asset given up, you will give it this first preference. If you don't have this, you will give the second preference to fair value of asset acquired. If you don't have either of this, in that case, you will give third preference to carrying amount of asset given up plus cash paid if any, plus cash paid if any, right? Yes, Deepak, great. So we will have these three preferences. Preference number one. So these preferences are for which asset? First, try to understand this. These preferences are for incoming asset. At what value the incoming asset will be recorded, right? So now in this question, do we have the fair value of asset given up? Which is a given up asset? Calculator. So do we have the fair value of this? The answer is yes, 90,000. So we will record iPhone at 90,000. We will record iPhone at 90,000. Sir, isn't this unfair? Because ideally we should record the iPhone at its own fair value. Why are we recording at the fair value of asset given up? See, now I'll try to tell you one thing. First, let me complete this entry and then I will tell you, okay? So ideally the preference is you will give the first preference to fair value of asset given up. So you will record the iPhone at 90,000 because the given up asset is calculator. The difference will be transferred to profit and loss. You will say profit on exchange. This is a realized profit. You will transfer it to profit and loss, okay? That is 30,000. That is 30,000. Now, the main question arises is, why are we giving first preference to given up and second preference to fair value of asset acquired, right? So these preferences are given by ICAI in the module. If you see the module, there are three preferences. But let me talk about Bare Act. If you see the Bare Act of Ind AS, three preferences are not given. So what does the Bare Act talk about? See, come in your notes. If you see note number 3, this is what Bare Act has to say. So Bare Act has only two preferences. The first preference is fair value of asset given up plus cash paid, or fair value of asset acquired, whichever is more clearly evident. So bare value doesn't do any bhedbhav. Bhedbhav means doesn't treat it differently. In Bare Act it is written that you will either give first preference to given up or acquired, whichever is more clearly available or evident. But what if both the values are available in the question? So for question solving point of view, we will follow ICAI's approach, where in all the questions where exchange concept is applied, ICAI has given first preference to fair value of asset given up. Is this clear to everyone? Yes, please remember this part, okay? So, and this again I'm saying that these preferences are for recording incoming asset, because outgoing asset is always going to go out at carrying amount. Is this clear to everyone, guys? Done, sir. Now let's take one more example in this concept of exchange, right? Second point. Let's say AK Limited. Is this clear? Yes or no, guys? Yes. We will take one more example, Achita, don't worry about it. So what if we did not have the fair value of given up? In that case, you would have taken the fair value of asset acquired. That means you will record iPhone at 1 lakh in that case. What if we don't have this as well? What if we don't have this as well? In that case, you will record the iPhone at carrying amount only of the outgoing asset. Okay? Okay, sir. Clear. Let's proceed further. Now, let's take example number 2. Let's say for AK Limited, he acquired an asset. Asset acquired was for iPhone 14. Let's say fair value was 1 lakh. And then there is asset given up. Then there is asset given up where we gave up calculator whose fair value was 90,000 Carrying amount was 60,000. But along with the calculator, we also gave one more asset, and that was cash. So basically, what we did was we acquired an iPhone. In exchange, we gave one calculator and we also gave some cash, right? So how much was the cash paid? It was, let's say, 20,000, right? So now we will try to understand what is the meaning of this cash paid, if any, right? But before that, I would like every one of you to take a minute and try to solve this on your own. You all guys will try this question on your own. Okay, what I want from you is the profit on exchange. What profit do you get on exchange? I'm giving you 30 seconds. Time starts now. Everyone will try, including the recorded students. Recorded students will pause the video and try this. Okay, try please. Try this. Okay, I'm giving you 30 seconds. Guys, what amount did you get as profit? Okay, 50,000, 50,000. So two people gave me an answer 50,000. Some gave me an answer of, okay, 10,000, 20,000, 30,000 also someone has given me. Okay. Some has said no profit, no loss. Okay. Okay. So glad that you guys tried. Now let me try the solution, right? Only I guess one or two of you have got the answer correct. Others answer incorrect most probably. But yes, glad that you tried. See, always your focus in class should not be to get the correct answer, but your focus in class should be to try out things, right? I am not concerned with your correct answer. I'm glad that you guys tried. That is appreciable. Okay, let's continue now. So what will be the journal entry? So first, always pass the journal entry. Okay, so which is the incoming asset? So you will say iPhone account debit. And which are the outgoing assets? So you will say to calculator. But you forgot one thing. Even we are paying cash now, so we will also have to do cash bank, right? Because we are paying some cash as well. Most of you might have forgot this. Okay, now these are the outgoing assets. Outgoing assets will always go out at what amount? At carrying amount. What is the carrying amount of calculator? 60,000. What is the carrying amount of cash bank? 20,000. This is done. Now to record the incoming asset, we have how many preferences? We have three preferences. The first preference says we will give first preference to fair value of asset given up plus cash paid, right? Ideally, see, when we say fair value of asset given up, this already includes cash paid. I'll tell you why also. Because in given up, it includes both the assets now, calculator as well as cash. But because you will forget this part, I have written specifically that you will have to include cash paid, right? So given up has two assets, calculator and cash paid. What is the fair value of calculator? 90. and the fair value of cash is 20. Fair value and carrying amount of cash is going to be the same. So for iPhone, at what value will you record it? You will say fair value of calculator plus cash. That is going to be 90,000 plus 20,000. That is going to be 1,10,000. Right? Now you will get some profit. What will be the profit on exchange? It will be 30,000. 30,000. Done? Okay, done, sir. So this was our second example. Of course, we will also solve some questions which are there in the book. Don't worry about it. Okay? Okay, sir. Now let's proceed further. Now under exchange only, I'm going to discuss one more concept, and that is sometimes the question mentions that the transaction lacks commercial substance. The transaction lacks commercial substance. Now, what is the meaning of this point? Let's try to understand this point of lacking commercial substance with the help of an example. Okay? Let's say here is Mr. AK. He's a poor guy, right? AK is a poor guy. Aakash Kandoi is very poor. That is why he has a small car, a two-seater small car, Ferrari. Now you can imagine now how poor he is, because he has only a two-seater car. Other people might have four-seater, five-seater, seven-seater, eight-seater cars. AK is very poor. He has only two-seater car. Okay, Ferrari. But this is a black color Ferrari. Okay? Okay, sir. Now, on the other hand, there is one guy. There is one guy. Elton. Guy named Elton. Okay? He also has a Ferrari. He also has a car. He also has the same Ferrari. But the only difference is, he is little bit inclined towards the color pink piggy poo. That means he has a Ferrari which has pink color. He's inclined towards such colors. Pink piggy poo. Pink piggy poo means pink color. Okay. Okay, sir. So here is one guy AK and here is one guy Elton. So we are talking from the point of view of AK. Okay. We will discuss everything from his point of view. Okay. So for AK, I will also give you some figures. The carrying amount is 1 CR. The fair value is, let's say, 1.2 CR. For L10, we don't have the carrying amount. We only have the fair value, that is 1.2 CR. See, if we are AK, we will know our carrying amount. We cannot know the carrying amount of other companies, right? That is fine. But now what we are trying to say here is, in case you can understand, we are exchanging the assets which are of same nature, same characteristics. Same goods are being exchanged, right? So in such case, the standard says that it lacks commercial substance, right? So I will write some theory here. See, write asset exchanged, put an arrow and then write same nature, same characteristics, again one arrow, therefore transaction lacks commercial substance. In such case, how many preferences do we have? Do we have those three preferences? The answer is no. We don't have three preferences in that case. We only have one preference. There is only one preference available. And that is, you will record the incoming asset at carrying amount of asset given up plus cash paid if any. You will record the asset at carrying amount of asset given up plus cash paid if any. Now, what does this imply? Let me try to pass a journal entry. We are passing the journal entry from whose point of view? From the point of view of AK Limited, right? So for AK Limited, the entry will be, for him, incoming asset is Ferrari pink color and the outgoing asset is Ferrari black color. Now at what value will the outgoing asset be derecognized? It will go out at carrying amount. 1 CR is the carrying amount. Now what about the incoming asset? The standard says that when you exchange the assets which are of same nature, you will also record the incoming asset at this carrying amount. That is 1 CR. We have only one preference in such case. Now you might ask, sir, what is the logic behind this? Why aren't we using the 3 preferences criteria? The logic is very simple. The standard says when you are exchanging the assets which are of same nature, they don't want us to book any profit on exchange. Like for example, let's say if you might have used the preferences. So the first preference would have been given to fair value of asset given up. The given up asset has a fair value of 1.2. In that case, you might have recorded the pink Ferrari at 1.2 CR. So you might have gotten balancing figure of 20 lakhs as profit on exchange. But the standard says, how can profit arise when you are exchanging the asset which are of same nature? That is why, to avoid such inflated booking of profit, the standard restricts the booking of incoming asset to carrying amount, right? So we can also write the reason here. Why only one preference? Why? Because they want us to avoid booking any profit on exchange. They want us to avoid booking any profit on exchange. Okay. I guess this is done and dusted. Ping piggy poo. Okay, sir. Done. I hope you get this point. This all is explained. These all points have been explained here, right? If you read this, you will be able to understand, but no need to read ideally, because if you have done the examples given in the textbook, given in my notebook, that those are more than sufficient. Okay. Okay, sir. Now, this was the criteria of initial measurement when the asset is acquired by way of exchange. Done. Next point. What if the asset is acquired by way of government grant? That means what if government provides you the asset for free, or government provides you the asset at a lower amount? So those things will be covered under Ind AS 20. Ind AS 20 talks about government grant. Like you had AS 12 for government grant, we have Ind AS 20. You might not remember A, that is fine, but we have Ind AS 20 for government grants, for treatment of government grants, right? So we will cover it there. No need to discuss it here. So this completes our point of initial measurement. I hope this is clear to everyone. Yes or no, guys? Guys, yes or no? Done? Okay. So now we can move on towards subsequent measurement. Now, what is the meaning of subsequent measurement? Subsequent measurement basically means at what value will you record at year end? See, you recorded the asset at cost on day 1. We know that. But at what value will it be recorded on year end? So for year end, we have basically two criteria, two options. You can either follow the cost model or you can follow the revaluation model. See, what is the meaning of revaluation model? That means you can keep the asset at fair value. Yesterday also, in case you remember, we took an example of land to understand the concept of OCI. So I said that Ind AS gives us two options, cost or fair value. But these two options are not available on day 1. These options become available from year end. Right? So the day you purchase the asset, you recorded a cost. And at each year end, you can follow either of the two models. Of course, whatever model you follow, you have to follow it consistently. Right? So one is cost model, one is revaluation model. Now, sir, how do we account under both the models? So what we can do is, we can understand this subsequent measurement, both models, in notebook. NB means notebook, right? So let's take out our notebook and write down how the accounting will be done under both these models. Okay. Okay. So give the heading. Subsequent measurement. Give this heading subsequent measurement. So first we are going to discuss about cost model. First we will discuss about cost model. Okay. So under cost model, how do we do the accounting? It is very simple. Let's say for example, for instance, you acquired a PP on day 1 for 10 lakhs, which has a life of 10 years. Okay. So what do? We deduct the depreciation for 1 year. What will be the amount of depreciation? 10 lakhs is the value, 10 years is the life. So depreciation per annum will be 1 lakh. So you will get the carrying amount at the end of 1 year as 9 lakhs. So under cost model, we will keep the asset at 9 lakhs only. It is as simple as that. Under cost model, we will keep the asset at 9 lakhs. This is our cost model. Simple. Very simple. Okay. Now let's move towards the second model, and that is revaluation model. Under revaluation model, at what value do we show the asset? So we show the asset at fair value basically. I'll tell you how. Let's say for example, on day 1 again, you purchased one PP at 10 lakhs, which has a life of 10 years. Okay. You will depreciate for 1 year. That will be 1 lakh. You will get the carrying amount at year 1 end as 9 lakhs. Now under revaluation model, what you will do is at the end of year 1 or at the year end, you will also be given with the fair value. Fair value at year 1 end is now, let's say, 12 lakhs. It is now 12 lakhs. Now under revaluation model, at what value will we keep the asset at year end? At 9 lakhs or 12 lakhs? So we will keep it at 12 lakhs. Similar situation we faced in yesterday's example. Remember when I was teaching you concept of OCI, we discussed the same part, right? When I was teaching on the concept of OCI, we discussed it that we have to increase the value of land. Similarly, here we have to increase the value of PPE from 9 lakhs to 12 lakhs, right? Okay, so done. So what will be the amount of revaluation gain, guys? What will be the amount? There will be gain, no? Because from 9 it is going up to 12. Fair value has increased. So there will be a revaluation gain. And yesterday we had studied that such gain, will it be transferred to PNL or OCI? Sir, OCI? Yeah, correct answer. It will be transferred to OCI, right? Amount will be 3 lakhs. Amount will be 3 lakhs. Okay. The journal entry for such increase will be PPE account debit to revaluation gain OCI 3 lakhs, 3 lakhs. Done. Now, can I ask you one question? Our carrying amount was 9 lakhs. We increased the value of PPE by 3 lakhs. So what will be my revised carrying amount after revaluation? So what I'm asking you is, what will be my revised carrying amount of PPE after revaluation? Perfect answer, it will be 12 lakhs. Sir, how come? It was 9 lakhs previously. We increased by 3 lakhs. 9 plus 3, 12 lakhs. What is the remaining life now? The remaining life is 9 years. Because previously it was 10 years. We depreciated and used the asset for 1 year, right? For 1 year. So now the remaining life is 9 years. Now, what will be the depreciation for year 2? Can anyone calculate the depreciation for year 2? So even I'll do it. Less depreciation for year 2. So now it will be 12 lakhs divided by 9 years, and it will be 1.33 lakhs. So what will be my carrying amount at the end of year 2? That is going to be 10.67 lakhs. That is going to be 10.67 lakhs. So now if you see this closely, your depreciation previously was only 1 lakhs. As soon as you revalued the asset, depreciation for year 2 increased. Sir, how do we give the effect of depreciation increase in previous years? Do we need to consider the effect in previous years also? The answer is no. Whenever your carrying amount increases, your depreciation changes prospectively. What is the meaning of prospectively? That means the day when the carrying amount changed, for future years your depreciation will increase. But you need not change the depreciation amount of your previous years. That is, you need not give any effect retrospectively. Right? Please remember this point. So such increase in depreciation, the effect will be given prospectively only. That is, the depreciation of future years are increasing. You cannot change the depreciation of previous years. Okay. Okay, sir, got this point. Done. Okay, so these are the two models which you can follow. If you come in our textbook, you can see the cost model is relatively very easy, right? We keep it at cost less accumulated depreciation. What is the meaning of this word accumulated depreciation? That means the depreciation till date, from the day you purchased the asset till today, what has been the cumulative depreciation, that is known as accumulated depreciation. Also, they have used one word less, accumulated impairment losses. So what is impairment losses? We will study about impairment losses under Ind AS 36. This word is used in revaluation model also. So we will study under Ind AS 36 what is impairment losses. Okay. But if you can see the revaluation model also, under revaluation model, we keep the asset at fair value and then less subsequent accumulated depreciation. Why subsequent word? Because as soon as you do this fair valuation, your subsequent depreciation changes for each year, right? So this model is very easy. Now, if you are choosing revaluation model, sir, first of all, does the company have a choice between these two, or company has to follow one prescribed by the Ind AS? Does Ind AS prescribe certain companies to follow this and some of them to follow this, or can the company choose on their own? So the companies can choose the model on their own. They have the option. They can either follow cost, they can either follow revaluation, right? If you are following revaluation, there are furthermore 5 points to be discussed. There are 5 more points to be discussed in case you are opting for this revaluation model. The first point to be discussed is the frequency of revaluation. Now, what is the meaning of this word frequency? The word frequency means this fair valuation. Likewise, let's say for example, the carrying amount at year 1 end was 9 lakhs. We computed the fair value, right? So do we need to find the fair value every year or every month or every day or every 2 to 3 years? How do we find the fair value? What should be the frequency of finding these fair values, right? So the first point is that. So standard says, if the fair value of the asset has very significant and volatile changes, like your asset is such that the market value changes very frequently, so you will have to find the fair value annually, at least once a year. But if the fair value has very insignificant changes, then in that case, it is fine even if you find the fair value every 3 to 5 years once, right? Not very important point, but something which will be helpful for the companies in real life. So how frequently should the fair valuation be done? If the changes are very significant, then annually. If the changes are insignificant, then once in every 3 to 5 years. Okay. So this was a very simple point. These points are relevant only when you are following revaluation model. Please remember. Okay. Now we come on towards the second point, and that is treatment of accumulated depreciation on date of revaluation. So what is the meaning of this point? So to understand this, we will try to take one example in the notebook. Okay. Yes. Sir, can fair valuation by registered valuer be relied for us? Yes. Normally, many of the assets won't have a direct fair value available because they might not be traded on exchange, right? So in that case, we appoint a valuer who can find out the fair value for us. Okay, Nishita? Yeah. Chalo. Let's proceed. Second point, treatment of accumulated depreciation on date of revaluation. What is the meaning of this point, sir? So we will try to understand with the help of an example. So let's take one example in a notebook. Example, treatment of accumulated depreciation. Treatment of accumulated depreciation. Let's say, for instance, we had a PP, we had an asset PP, which had a cost on day one. Day one cost was 100 lakhs. Let's assume the life to be 5 years. Okay. Life was, let's say, 5 years. Okay, sir. So now, let's say we used the asset for 2 years. We used it. 2 years, we used it. 2 years use kiya. So, we will charge depreciation for 2 years. So, we will say less 2 years depreciation. What will be the cumulative depreciation of 2 years? So, you can clearly see it will be 40 lakhs. Sir, how? 100 lakhs into 2 divided by 5. Right? 40 lakhs. So, if we deduct this, you will get the carrying amount. But of course, this is carrying amount at the end of year 2. At year 2 end. Okay. It will be how much? 60 lakhs. It will be 60 lakhs. Okay. Now, in case you are familiar with some terms, this 100 lakhs is known as gross block. Okay. This 40 lakhs is known as accumulated depreciation. Okay. And this 60 lakhs is known as net block. You might have heard these terms somewhere. Maybe not very much aware about what it says. So gross block is nothing but the original cost at which you purchased. What is the meaning of accumulated depreciation? When you purchase the asset from that date till today, what has been the cumulative depreciation? That is known as accumulated depreciation. And then we get net block. Okay. Okay. It is, Sachin, it is. Okay. Also, we have been given the fair value. So let's assume the fair value at the end of year 2 is, let's say, 75 lakhs. So of course, we will have some revaluation gain. We will have some of 15 lakhs. Okay. Okay. Also, if you need to see the extract of balance sheet. So what is the meaning of balance sheet extract? Balance sheet extract means showing the relevant portion of balance sheet. Okay. One sec. So under balance sheet, how will the presentation be done? Let me show it to you. So let's say we have an asset. Under asset side, under the heading non-current asset, we would have shown PP. So PP will have ideally 3 elements: gross block 100 less accumulated depreciation 40, then you will get net block as 60. Right? Gross block less accumulated depreciation, then you will get the net block. Ideally, this presentation is not done on the face of the balance sheet. This is done under notes to accounts. But just for presentation purpose, I'm showing it here as well. Okay. Yeah. So now, in this point, what are we ideally going to discuss? So we are going to discuss, once you do a revaluation, what will be the treatment of this accumulated depreciation till date? So do we need to do anything with this? The answer is yes. 2 treatments have been prescribed for this. So first we will try to understand what are those 2 treatments. Once you understand it, then only we can also discuss the logic behind this. Okay. So initially first try to understand what are those 2 treatments, and then we will discuss the logic. Okay. So we can write it down as accumulated depreciation was rupees 40 lakhs. So as I said, 2 treatments have been prescribed. Method number 1 is that we will eliminate accumulated depreciation. And the method number 2 is we will not eliminate. Do not eliminate. Accumulated depreciation. Method number 2 is do not eliminate. First is eliminate accumulated depreciation. Second is do not eliminate accumulated depreciation. Clear, guys? Yes, sir. Thank you, Ritik. Okay. Now under method number one, what do we do? So the standard says whatever depreciation is being shown in the balance sheet, you will eliminate this. Why? Because your net block is changing, and the detailed discussion we can only do once both the methods have been discussed, right? So the first method is saying that you will have to eliminate this accumulated depreciation. Sir, how do we eliminate this? We will have to eliminate this against the gross block. We will have to eliminate this against the gross block. Sir, okay, how do we eliminate? We have to pass one journal entry. How do we pass the entry? Let's suppose PP, we have a gross block. Gross block has asset always has a debit balance. PP is shown under asset side. Asset always has a debit balance. But accumulated depreciation, we are reducing from the asset. That means accumulated depreciation is like a liability balance for us, if I'm not wrong, right? It is like a liability balance. Sir, why am I saying all these things? So that you can pass the journal entry very easily. How come? I am saying that I want to eliminate a liability kind of a thing against gross block. So what entry do we pass? What entry do we pass? So if I want to eliminate a liability, I will debit it. And if I want to reduce the gross block as well, I will credit the asset to reduce it, right? So the entry which forms here is accumulated depreciation account debit 40 to gross block of PP 40. Perfect answer, Nishita. Perfect answer, Supraja. Perfect answer, everyone. The entry will be accumulated depreciation account debit to gross block of PP. We have to eliminate. This is the first method which we do. First entry under this method. Second entry, now what we can pass is of booking the revaluation gain. So we will now book the revaluation gain. How do we pass the entry? We will say PPE account debit to revaluation gain transfer to OCI 15 15 15 and 15, right? PP to revaluation gain 15 15. So ideally under method number 1 you have to pass two entries. One is of eliminating the depreciation, second is of booking the gain. So what are the effects of this entry? If I want to show you the effect, I can prepare one balance sheet extract. I can prepare one balance sheet extract. Just try to see the balance sheet extract as well. In our PPE, now after we eliminate the depreciation against gross block, our gross block and net block both become 60. Again, I'll repeat. After we eliminate this 40 against gross block, our gross block and net block both become 60, right? So, our gross block as well as net block both become 60 after elimination. Then, of course, we book a revaluation gain of 15 and we get the value of PP. You can call it net block, gross block because both are going to be same as 75. See, on the face of it, you might find it little bit tricky, but I can promise you, you just give me 15 minutes more. I can promise you that you will be able to solve these things on your own. I can guarantee this. Just give me 15 minutes. Okay. Because see, whenever you are learning anything for the first time, you can't expect yourself to be very efficient with that. As and when I teach you something, then we do one question, then you try it on your own, you will of course become very much comfortable with it. So always keep this approach in mind. Okay. Okay, sir. So this was the first method where we will eliminate the depreciation. Okay. Now we will move on towards the second method. And that is, what if we do not want to eliminate the accumulated depreciation? What if we do not want to eliminate the accumulated depreciation? So in that case, you will have to follow 3 steps. In this case, we have to follow 3 steps. What are those 3 steps? The first step is going to be find the percentage of gain. Sir, how do we find this? What was the amount of gain? 15 lakhs, right? You will divide it by the carrying amount, because ideally this gain we got on carrying amount. Our carrying amount was 60, fair value was 75, we got a gain of 15, right? So to find the percentage gain, what we will do is we will say revaluation gain divide by the carrying amount, into 100. That is equal to 15 divided by 60 into 100. What percentage do you get, guys? Perfect answer, you will get it as 25%. This is our first step. Okay, we have to follow 3 steps. Okay, first step is done. Second step, we will have to apply this percentage on 2 amounts. We will have to apply this percentage gain on 2 amounts. One is gross block, and the other one is accumulated depreciation. We will have to apply this percentage gain on 2 amounts. One is gross block and the other one is accumulated depreciation. So how do we do it? We will have to apply this 25% on the value of 100, that is a gross block. Also, we have to apply this 25% on the value of accumulated depreciation, that is 40, right? So how do we do it? Let's try to see this. For gross block, we will say 100 into 25%, which is equal to 25, right? Because we are applying the percentage on gross block. Also, we will have to apply this percentage on accumulated depreciation, that is 40 into 25%. So we'll get the amount as 10. So you got these 2 amounts. On gross block, when you applied, you got 25. On depreciation, when you applied, you got 10. The third step is passing journal entries. The third step is passing journal entries. Now, how do we pass a journal entry? So whatever amount you got in step number 2, you will have to increase both these items by this amount. Whatever amount you got in step number 2, you will have to increase both these items by this amount. That means I have to increase the gross block by 25. I have to increase the deb by 10. How will I do it? If I want to increase the gross block, I will debit the gross block 25. If I want to increase the accumulated depreciation, I will credit it by 10. You will get a balancing figure. Your balancing figure will exactly match with the amount of revaluation gain. So you will call this as revaluation gain, which is transferred to OCI. So ideally we pass a single entry here in step number 3. In method number 1, we were passing 2 different entries. Here we pass a single entry, right? So these are the 3 steps. First step is finding the percentage gain. Second step is applying that percentage gain upon 2 amounts. And then third step is passing the necessary journal entries. Is this clear to everyone? Now, I know you might have a certain question that, sir, what is the logic behind doing all these things? I can prove it to you. Now just see this, okay? Just try to feel the logic. Let's say we have a balance sheet. After doing all these things, after doing what we just did in the above 3 steps, right? How will our PP reflect? The gross block of PP was initially 100. We increased by 25. So gross block will become 125. Our accumulated depreciation was previously 40. We increased by 10. So it will be 50. You will automatically get the answer of net block as 75, right? So once you increase the gross block and depreciation, you will get the answer of net block and you will automatically get the revised value after revaluation. after revaluation. But again, the question lies, sir, what is the logic behind increasing these two things? Now, get ready for the logic. Tell me one thing. Our net block was previously 60 rupees, right? 60 lakhs. We increased it by 15 lakhs. That means by how much percentage the net block increased? By how much percentage the net block increased? So, can I say that this increased by 25%? That is the exact amount we found in step number 1. We can say the net block increased by 25%. That is the exact value which we found in step number 1. The standard says you can't, if you want to keep this in your balance sheet, if you want to keep the accumulated depreciation in your balance sheet and not eliminate it, you will also have to increase these two amounts by 25%. Because if you don't increase these two amounts, this won't come, na? The answer of 75 won't come, right? So the standard now says, now try to understand the logic behind this. Under the first method, it says because you are revaluing the net block, just eliminate the old things, just eliminate what was there previously. So we eliminated the accumulated depreciation against the gross block, and then we directly booked the gain on the net block, right? So therefore there was only one thing, net block, which was showing, right? There was no accumulated depreciation. But in the method number 2, when you chose that you do not want to eliminate this and you want to keep showing this, so what you have to do is your net block is getting increased by 25%. So ideally you should also have to increase your gross block and depreciation so that it matches, right? Once you do gross block minus accumulated depreciation, the answer of 75 should come. That is why when we increase the net block by 25%, we also increase by 25% gross block and depreciation amount as well. That is why we have to follow these 3 steps: finding the percentage gain, applying the percentage gain, and then passing the journal entry. So these are the 2 methods. Of course, this will seem to be unusual on the face of it because, as I had already said, that during articleship you work in account, you work in auditing, you work in taxation, but you have never applied Ind AS during articleship, right? You, of course, you will go through the financials, but you have not you are not prepared the financials as per Ind AS on your own. That is why you are not familiar with all these things, right? But these happen once, maybe after CA final, when you get a job, maybe in the field of Ind AS or financial reporting, you will have to do all these things for a company, right? So you might be knowing, you have to know all both the methods. Sir, ideally in exam, do we need to follow both the methods? The answer is yes. In exam, you need to solve by both the methods, right? But in real life, company will choose either of these. I hope you get this point. Okay. So now what I'll do is I'm giving you 1 minute to revise this whole example. I'm giving 1 minute. Why? Once you revise, I will give you one question based on this concept as well, for you to solve it on your own, right? So the recorded students will pause the video and try to revise it on their own. Live students, you will have to revise this. I'm giving you 1 minute. Okay, time starts now. Someone has asked that what if revaluation loss occurs? This concept is applicable only when you have a revaluation gain. Please revise. Once the revision is done, you will write D in the chat box. D means done. Done, guys? Done revising? Okay. Now time for one question. So let's open our question answer book. Hi Sumit, hello. Chalo, let's do one question. Let's do this question. You can see illustration number 23. Mark this question as LDR. Eldorado. Eldorado means LDR, right? I had explained the concept of LDR yesterday, right? Okay, so mark this question as LDR. Okay. Let's read this question. What the question says. Company X performed a reevaluation of all its plant and machinery at the beginning of 2011. The following information relates to one of the machinery, right? So they have given the information of gross block, accumulated depreciation, and net block, and then they have also given the fair value. What they have mentioned is the useful life of machinery is 10 years and company uses SLM method of depreciation. The reevaluation was performed at the end of 4 years. That means out of 10 years, 4 years have lapsed. That is 6 years are remaining. The remaining useful life is how much years as on today? The remaining useful life is, remaining means balance useful life. It is 6 years, right? How should the company account for the reevaluation of plant and machinery and depreciation subsequent to revaluation? They are asking us to account for revaluation. We will say it will be transferred to OCI, and also they are asking us how to account for depreciation. So we have to follow the two methods. See, sometimes you might feel that this question was not very much clear as to that they are asking for the accumulated depreciation. This happens when you read the question from module, but when the question comes in exam the question is very much clear as to what they require from you, right? Sometimes in question when you are studying from module, it might happen that the question might not be that clear, and the reason for that is in module what the institute does is it explains the concept, and below the relevant concept only the question is discussed, so it becomes implied for anyone to assume that this question was based on this particular concept. But in exam, of course, you can assume the question to be much more clear than this. Okay, don't worry about it. Okay, so we need to give the two methods, also support our answer with journal entries. Okay, for the initial phase I will help you with, but then for applying the two methods you will have to do it on your own so that we can check whether you have understood the concept or not. Let's see. Illustration 23, we can say it is LDR. Okay, so first write gross block 200, life was 10 years, less accumulated depreciation. Because we used it for 4 years, it will come for 4 years, that is 80. Then you will get carrying amount, at the end of year 4, that is 120. Then you will get fair value at the end of year 4, which was given as 150, right? Acha, also we can write after depreciation the remaining life is 6 years. Okay, what is the amount of revaluation gain? We get it as 30. Now what is to be done? What I require from you is you will give this heading treatment of accumulated depreciation, and you will try to solve the question under both the methods. Do you remember method number 1? What was method number 1? That we will eliminate accumulated depreciation. And what is method number 2? That we will not eliminate accumulated depreciation. So now first you will have to solve under method number 1. You will pass the entries and then you will, after method number 1, of course, when you solve this, leave 3-4 lines. I want to make you write one more sentence. And after method number, you will do as per method number 2. I want every one of you to try. Okay. The recorded students will also try this. Okay. Time starts now. Please try, giving you exactly 1 minute. Okay. Start. Guys, done trying? Done? Glad you tried, guys. Now it's my turn. Okay. So what we will do in the first method, when we have to eliminate, we will pass a simple entry. Accumulated depreciation, account debit to PPE, that is the gross block, and it will be 80 and 80. The second entry we will pass is directly of booking the gain, that is PP gross block slash net block account debit to revaluation gain 30 30. Such gain of course will be transferred to OCI. Also, if I ask you one thing, which you can of course answer me, what will be the revised carrying amount at the end of year 4? Like after you do this elimination, after you do this booking of revaluation gain, what will be the revised carrying amount? Very good answer, everyone. It will be the revised carrying amount at the end of year 4 will be 150. Life will be 6 years, right, at the end of year 4. And if I ask you what will be the subsequent depreciation per annum, depreciation per annum from 5th year onwards. So how much will it be? Simple, 150 divided by 6, that is equal to 25 per annum. If the question asks, you can also mention this. Okay, this is our method number 1. Method number 2 is the simplest method, right? So we can write method number 2, where we will say do not eliminate. Do not eliminate accumulated depreciation. So here we will follow 3 steps. Step number 1 is going to be finding the percentage gain. Step number 1 will be finding the percentage gain, that is revaluation gain divided by carrying amount into 100. That is going to be how much? 30 divided by 120 into 100, and that will give you a percentage of 25%. Now what you have to do is you have to apply this 25%, apply this percentage gain on 2 figures, on gross block and accumulated depreciation, guys. It will be 200 into 25%, that is equal to 50, and it will be 80 into 25%, that will be equal to 20. Right? Yes, sir. Perfect. So now the third step is passing journal entry. So these above two amounts have to be increased by this value. So we will say gross block account debit 50 to accumulated depreciation 20, and as I said, it will surely match with the amount of revaluation gain. Right? If you want to see the balance sheet extract, your gross block will become 250. Previously it was 200. It will become 250 after the increase. Your depreciation will be 100 and your net block will be 150. And your net block will be 150. Simple. Acha, if I ask you under method number 2 also, what will be my revised carrying amount? The revised carrying amount and the revised depreciation under both the methods will be same. It will not change. Please remember that part. This part under both the methods will be the same only. Also, if they ask you the journal entry for depreciation, you can pass the entry for depreciation also. Future, that 25 rupees ka entry, it will be depreciation to PP. In case if they ask you. A very good question. Can I say that you might have been much more comfortable compared to when I was explaining the concept? That is what I'm trying to tell you. Once you are studying anything for the first time, you will feel that it is tricky because you are studying it for the first time. Once you have that patience, once you listen to me very carefully, and once you just focus on understanding it initially, when the question comes, it will become a piece of cake for you. Right? So this was done. So what we just completed was the treatment of accumulated depreciation on date of revaluation. Right? We have two methods again. Simple. Sonam says ek ke hai bhai sahab. This means ek ke bhai sahab means you can say brother, big brother. Anyways, so actually I use these tunes and phrases in Hindi batch. So I'm not very much efficient in converting them into English, but you can understand. Okay, that's fine. Okay. Anyways, so now I guess we deserve a small break, and after the break we can resume. So see you after the break, guys. Thank you so much. Bye bye. Everyone, take care. See you all. Bye bye. See you after the break. Bye bye. At what time do we meet, guys? How about meeting at 7:40? We meet at 7:40. Works? See you after the break. Bye bye. Welcome back after the break, everyone. Are you guys ready to continue? Yes or no? Shall we continue, guys? I guess we are absolutely ready to continue this. Okay, we can. Let's start. So, welcome back after the break, guys. So, we were studying this concept of revaluation model. Under this, we have already completed how many points? 2 points, right? We have completed frequency of revaluation and we have also completed this treatment of accumulated depreciation, right? Now we will move on towards the third point. Okay. Thank you so much, Pratham. Thank you so much. Okay. Now we will study this third point. Acha. Before starting the third point, um, let me tell you one story. Okay, let's divert from the studies, and this story is going to be very relevant as well for you, for many CA students, because during CA, the most important part is staying motivated during these 3, 4, 5 years, right? It is very difficult for anyone to stay motivated for such a long period of time. But okay, let me share one story with you. Okay, so sometimes generally this story is based on, I'll tell you, this story is based on something where students keep on asking me what is the value of a CA degree. Some say that sir, CAs are not getting job in the market, right? Some says that is CA after multiple attempts worth it. So when I share this story now, you will come to know what is the value of your CA degree. Okay, so how about sharing a small story about 3 to 4 minutes? Yes, are you ready, guys, are you ready? Okay, chalo. Let me share you one story. So let's say there was one farmer. Okay, he was very much frustrated with his life. Okay, he was into agriculture, of course, but he was not getting the desired output. Whatever he used to grow used to get washed away. Sometimes some natural calamity used to occur. He was very depressed. Okay, so he thought, what is the value of his life? He can't even feed his family. So what is the value of his life? He was very depressed about this. Okay, so he started staying depressed, but he was a very good believer in God. Okay, he used to day night pray to God about well-being of his family and everything, right? So he was a, you in Hindi we say bhakt. He was a good bhakt. Bhakt means he was a believer of God. Okay, so he used to do his prayers on a timely basis, but he was very frustrated now. So what he decided, let's attempt suicide. So he decided to attempt suicide. And at that particular time, when he went to commit suicide, at that time, God appeared. God appeared and asked him, what is your issue? Why are you taking this bold step? What will happen to your family and everything? So he said to God that, God, I don't know what is the value of my life. I can't even feed my family. I'm not able to do anything with my life. So please tell me the value of my life, or else I don't feel like living in this world anymore. Right? So God said, okay, if you want to commit suicide, of course you can. No one will stop you. But before committing suicide, just do one work for me. You can do one work for me, right? So the farmer said, okay, I'll do it. So God gave him a red stone. God gave him a red stone. God gave him a red stone and told the farmer that, please find out the value of this red stone from various vendors. Go to different kinds of shops and find the value of this red stone. Okay, it was colored red, it was a red color stone. So the God told him to take this stone to different vendors and try to find the value of this. But God also told him that please do not sell this red stone to anyone. Okay, just try to find the value and come back in the evening and tell me what the different vendors had to offer, but please don't sell it to anyone. So farmer said, okay. So farmer took the stone. First he went to a potato vendor, right? Potato vendor. So he told the potato vendor, see, I have this red stone. What you have to offer for this? So the potato vendor saw it. It was shiny red stone. So potato vendor said, okay, I will give you 1 kg of potato in exchange for this red stone. So he said, okay, but I don't wish to sell it to you. Okay, then he moved on. He went on towards a mango vendor. A mango vendor saw it and he said, okay, it looks good. So I will give you 10 kgs of mango. I will give you 10 kgs of mango for this red stone. So The farmer said, okay, but I refuse to sell it to you. Then he went towards a iron vendor. You know iron vendor? In Hindi we call iron as lokhand. Iron vendor. Right. So iron vendor saw it and he said, okay, I will give you 50 kgs of iron in exchange for this stone. In exchange for this stone. But farmer said, okay, the value is keeping on increasing of this stone, but I don't wish to sell it to you. Then he saw one shop, a jewelry shop. So he went on towards that jewelry shop. He showed that red stone to the jewelry owner, shop owner. He saw it and he immediately knew that this is not a normal red stone. This is not a normal red stone. He immediately knew it. Then he saw the outfit of farmer and then he thought that let's offer him something less compared to its value. So the jewelry owner offered him 10 kgs of gold plus 2 crores cash in exchange for this red stone. The farmer was shocked to know this, that for this red stone someone was offering only 1 kg of potato and this jewelry owner, the shop owner was offering 10 kgs of gold plus 2 crores of cash. The farmer was amazed, but still he couldn't sell it because God had asked him to not sell it. So he went on and he thought that let's try one more place. Then he saw a diamond shop. So he went into the shop and showed this red stone to the shop owner of diamond shop. The diamond shop owner, as soon as the diamond shop owner saw it, he immediately knew that this is not a normal red stone. It is a red diamond which exists only one in this whole world. So the diamond shop owner was amazed and he was ready to give his whole shop, whole diamond shop, whole property, plus shop, plus everything he had in exchange for this red stone. The diamond shop owner was ready to give everything he had in exchange for this red stone. The farmer was surprised. Again, he told him that, but I cannot sell it. But the farmer was very excited to tell all these events to the god. So he came back running and went towards the god and told the god what all things happened. That he offered the potato vendor, he said 1 kg of potato he will offer. Then he said all these events. Now, what the god had to tell the farmer is what we need to actually learn. God told him that this red stone is nothing but the solution to your answer. The farmer was asking now what is the value of his life? The value of anyone's life is equivalent to the red stone. It depends on you, how you are utilizing it. Whether you choose to sell yourself to a potato vendor or you choose to save yourself for the diamond shop owner. Same applies to a CA degree. Someone asked me that what is the value of CA degree? It depends what you choose to do with this degree. This degree has a potential for someone to build crores and millions of rupees. But it depends on you how you choose to utilize this. I hope you are able to understand this point, right? See, the motive behind doing CA should not always be earning money, but the worth, the knowledge which you get, the hard work which you learn during this journey cannot be compared with anything, right? So it depends on you how you choose to value your course, your life, your anything, whatever you have. Because as I can say, see, a person like this will exist only one in the world. Like for example, we have Pratham. Pratham is only one in the world. There are not multiple Prathams, right? There can be many other people who might be better than Pratham, who might be not better than Pratham, but Pratham is only one in this world. That is what I'm telling you. A CA like you, a person like you is only one in this world. So you should choose what should be your value, right? Of course. So anyways, did you like the story? It was nice, right? So I will keep on sharing such stories during the batch. Okay, don't worry about it. But was it nice? Yes or no? Was it nice? Superb, so super. Okay, thank you. Okay. Bidu मेरा बच्चा है तू. This means Bidu, you are my son. Nice, sir. Okay, thank you. Chalo, let's proceed. Now, where are we heading? We are heading towards the revaluation model. Next points. First and second point is already covered. Third point. Revaluation to be applied to entire class of asset. Now, what is the meaning of this point? Revaluation to be applied to entire class of asset. This means that, what is the meaning of entire class of asset? All assets having same nature, same characteristics are known as same, will belong to one class. For example, let's say I have this one iPhone, another iPhone, and another iPhone. Let's say I have three iPhones. I have three iPhones or three mobile phones, let's say, for example. Okay. So if you are choosing to revalue one mobile phone, you will have to apply the revaluation model to all the mobile phones. That means if you choose this model, you will have to apply it to entire class of asset. Simple. Right? Let's say, for example, I have 5 laptops. So if I choose to apply a revaluation model to one of the laptop, I will have to apply it to all the laptops. You can apply different models to different classes. Let's say, for example, I can apply different model. I can apply cost model to the buildings I have. I can apply reval model to the mobile phones I have. Different classes, different methods are allowed for different classes. But if any asset belong to the same class, you will have to apply that single method, right? So we will write it down. We will write down something here. What is the meaning of entire class? Group of assets having same nature, same characteristics. That is known as entire class. And what is written is, if an item of PP is revalued, entire class shall be revalued. Simple. Right? And what comprises of separate classes? The examples are given here. You can read it once. Okay. Now one more case is discussed. Let's say, for example, a company has office building and a company also has factory building. So now see, both are buildings, but one is office building and one is factory building. So will these two buildings be considered as a single class of asset or different class of assets? Right? So just because they have building in their surname, that doesn't in their surname, that doesn't mean that these are same class of asset. One is office building, one is factory building. So these will be considered as different classes. That means you can apply different models on this. See, I'll give you a very simple example. Let's say you know Mukesh Ambani. Mukesh Ambani's son's name is Aakash Ambani. Okay. So we have Aakash Ambani also, and we have Aakash Kandoi also. Okay. So do you feel just because our name is same, our net worth will also be same? Of course not. Aakash Ambani is very, very rich. Aakash Kandoi is very, very poor. So just because our name is Aakash, that doesn't mean I am also rich, na? Same applies to here. Just because they both are building, that doesn't mean that they belong to the same class. Right? Got your point, sir. Okay. So it is mentioned here. Industrial building and office building can be classified as different classes. Simple. Done. Next point. Treatment of revaluation gain and losses. We always discussed what if we get a what if we get gain, revaluation gain, we will transfer it to OCI. But what if we get a revaluation loss on day one? Then what is to be done in that case? So we will discuss this point with the help of an example and we will write it down in notebook. So just mention, we will discuss this in notebook. Okay. Treatment of revaluation gain and loss. Let's take one example. Treatment of revaluation gains and losses. What is the meaning of revaluation? It means unrealized gains and losses, right? So now, what is the treatment? Sir, it is so simple. It will be transferred to OCI. No, not in all cases. Just try to understand this point, okay? So first you have to check whether you are doing the revaluation for the first time or not. So this can be bifurcated into two parts. What if you are doing revaluation for the first time, which is known as first time revaluation? which is known as first time revaluation, and the other one is subsequent revaluation. And the other one is subsequent revaluation. Okay, one is first time revaluation, other one is subsequent revaluation, right? Okay, so now what if we get a revaluation gain? See, please try to understand. Okay, if you are revaluing it for the first time and you get a revaluation gain, where will it be transferred? We already know. Where will it be transferred? Perfect answer, it will be transferred to OCI, sir. Done, sir. Okay, what if you get a revaluation loss in the first time? If you are revaluing it for the first time and you get a revaluation loss, where will it be transferred? So now you might say that, sir, OCI only. The answer is no. See, Ind AS prescribes you to follow fair value model, but even Ind AS is conservative at certain places. So for gain, it says that you have to show it in OCI, but for loss, if you have a revaluation loss, you know where does Ind AS tell it to book? You have to book this loss in perfect answer, profit and loss. Very good answer. You have to book this in profit and loss. So if you have a first time revaluation gain, you will book in OCI. If you have a first time revaluation loss, you will book in profit and loss. Got this point? Yes, sir. What if now this is simple, done and dusted, sir. Now the important part is this subsequent revaluation. What is the meaning of subsequent revaluation? Let's say you are not revaluing for the first time in your life. This is subsequent revaluation. That means you have already revalued once, and in second or maybe third year you are revaluing it again. So let's say you are doing subsequent revaluation and you get a revaluation gain. Now where this revaluation gain will get transferred? So if you say OCI, the answer is wrong. When you are revaluing it subsequently, you cannot give a direct answer. For this you will have to check what answer did you previously get. Let's say for example, now you got revaluation gain. So they will ask you, when you did your previous revaluations, what did you get, gain or loss, right? So let's say I revalued it today, I got a gain, and when they are asking me what you had previously on this asset, I am saying previously also I had a gain. Previously also I had a gain. So if previously also you had a gain and now also you are getting one gain, so the current gain, existing gain, this gain, current gain will be transferred to OCI. Current gain will be transferred to OCI. Previously also there was gain and currently also you got a gain, so this gain will be transferred to OCI. But the main part comes here is, what if you had a loss previously and now you are getting one gain? What if this situation arises? So you revalued for the first time, you got a loss and now you are getting a gain. So do you feel we should transfer the current gain to OCI? Do you feel we should transfer the current gain to OCI? The answer is no. Please apply basic common sense and tell me what should be done with the current gain if previously you had a loss. What should be done with the current gain if previously you had a loss? Absolutely correct answer. Such existing gain should first be settled off against the previous loss. That means if you are getting a gain now but previously you had a loss, such a gain should first be settled off against previous loss. That means to the extent of your previous loss, current gain should be transferred to profit and loss, because first you want to set off the loss. See, what is the logic behind this? Ind AS being conservative told you to transfer all the losses to profit and loss. Now when on the same asset you are getting a gain, at least you should be allowed to transfer such gain to P&L to the extent they asked you to book the loss. That is why they are saying that if you get a gain now but previously you had a loss, just write down what I'm writing so that it becomes easier to retain, right? To the extent of previous loss existing gain will be transferred to P&L. To the extent of previous loss, existing gain will be transferred to P&L. Sir, what if the gain exceeds the amount of loss? Sir, what if the gain exceeds the amount of loss? In that case, the excess gain will be transferred to OCI. We will say excess gain, if any, will be transferred to OCI. Now let us try to understand this with the help of few examples that will give you some clarity over this. Okay, let's write some examples down. Let's take example number 1. Okay, so let's assume in the first time you had a revaluation gain of 70. Tell me, if in the first time you get a revaluation gain, where will this gain get transferred? Of course, the answer is OCI. Very good. Now let's assume you do subsequent revaluation as well. On subsequent revaluation also you get a gain of 20. Where will this gain get transferred? So you will have to check what you had previously. So previously you had a gain. Now also you are having a gain. So such existing gain will also be transferred to OCI. Simple. Okay? Okay, sir. Example number 2. You revalued for the first time. You had a revaluation loss. On first time revaluation, you had a revaluation loss of 100. Where will this get transferred? 100 to profit and loss. Okay. On subsequent revaluation, you got a revaluation gain. So first you had a loss, you transferred it to profit and loss. Now you are having a gain. How much gain are we having? Let's say you are having a gain of 80. So now where will this gain get transferred? So first see whether this gain is well within the limit of the loss. The answer is yes. So to the extent of previous loss, we can adjust this gain with profit and loss, right? So perfect answer, such gain will also be transferred to profit and loss. So when you are getting a subsequent revaluation gain, you cannot directly say OCI. You will have to check what you had previously. So previously, if you had a loss, you must have transferred the loss to profit and loss. So existing gain will also be adjusted to profit and loss to the extent of previous loss. Okay. Let's take one more example. Example number 3. Let's say on first time you had a revaluation loss. On first time you had a revaluation loss of 100. So this was transferred to P&L. On subsequent revaluation, you got a gain of 130. I want everyone to answer this. You had a loss of 100, which was transferred to P&L during the first time. Subsequently, you have a gain of 130. What is to be done with this? Please answer, everyone. Tell me. What will be the answer to this on subsequent revaluation? Perfect answer, everyone, sir. Previously, we had a loss of 100, but now we are getting a gain of 130. So to the extent of previous loss, 100 ka gain will be transferred to profit and loss to the extent of previous loss. Whatever excess gain you have, that will be transferred to 30 gain balancing figure you are getting. This will be transferred to OCI. Simple. Right? 30 gain you will be transferred to OCI. Clear? Please keep a cool and calm mind while answering this. Okay. In hurry, you might give the incorrect answer. Okay. Just keep a cool and calm mind. It is very simple. It is very logical. It is very easy. Clear, guys? Perfect answer, everyone. Okay. Let's proceed further. Same logic applies to if you have a revaluation loss on subsequent revaluation. Let's say, for example, you have a revaluation loss on subsequent revaluation. They will ask you what you had previously. So let's say now also you have a loss. Previously also you had a loss only. So now also loss, previously also loss. So existing loss will be transferred to profit and loss. So current loss will be transferred to profit and loss. But what if previously you had a gain and now you are getting a loss? So again the set of provisions will become applicable. So previously there was a gain, you might have transferred the gain to OCI. Now you are getting a loss. So first adjust the loss with OCI. Then excess loss, if any, will be transferred to profit and loss. Right? So we'll write this down as well. To the extent of previous gain, existing loss will be transferred to OCI. Balance loss, if any, will be transferred to profit and loss. Balance loss, if any, will be transferred to profit and loss. Okay. Balance loss, if any, will be transferred to profit and loss. Okay. Let's take 2-3 more examples on this. Let's say we have example number 4, where we had a gain first when we revalued for the first time. We had a gain. So you revalued for the first time. On first time you got a revaluation gain, okay, of let's say rupees 100. So you transferred it to OCI. Simple. Yes sir. Now on subsequent revaluation, you have a revaluation loss of let's say 80. The loss is well within the limits of the gain. So such loss will first be setted off. So it will be transferred to OCI. Are you getting this point? Please don't get confused. If you are having a basic common sense, you will be able to crack this. Okay. If you are getting gain previously, you transfer it to OCI. Now if you are getting a loss, first set off against the previous gain. So to the extent of 100, you will transfer to OCI. This loss is well within 100. So this will be transferred to OCI. Simple. Example number 5. Okay. You are doing revaluation for the first time. You get a revaluation gain of how much? Of 100. Then you do subsequent revaluation. You get a revaluation loss of let's say 150. I want you guys to try this. See, the first time gain would have been transferred to OCI. Now you are getting a loss. Please tell me, well, where will this loss get transferred? Perfect answer, everyone. The loss is of 150. So first set off against the previous gain. So to the extent of 100, you will transfer to OCI. Balance 50, you will transfer to profit and loss. Simple. Very good, everyone. Very good answer. Right, guys? So 100 ka loss will be transferred to profit and loss. Balancing figure 50 will be transferred to, 100 ka loss will be transferred to OCI. Balancing figure 50 will be transferred to profit and loss. Clear? Absolutely clear, sir. Okay. Should I take one more example, which is one advanced example? I don't know whether you will be able to answer this or not, but let's just try one advanced example because some students might have this query. Let's go one step further ahead. How about this? Are you ready, guys? Guys, are you ready? Okay. Let's say you revalued for the first time. You had a revaluation loss, okay, of 100. So this was transferred to P&L. I get it. You revalued for the second time. You got a revaluation gain of 75. You got a revaluation gain of 75. So first, whenever you revalue subsequently, you will see what you had for the first time. So first we had a loss, then we have a gain. So this gain will be adjusted against previous loss. So 75 is within the limit of 100 only. So we will transfer 75 to profit and loss. Now we are revaluing for the third time. We get a gain again. But the amount of gain is 30. Tell me what is to be done with this 30. Where will it get transferred? This is going on for the same asset, okay? First time you got a loss, then you got a profit, then again you got a profit. Perfect answer, sir. Out of 100 ka loss, we have already adjusted 75 ka gain with this loss. So how much balance loss was pending out of this 100? 25 loss was pending. So to the extent of 25, this 25 gain will be transferred to profit and loss. The balancing figure 5 will be transferred to OCI. A very, you can say, basic question, but very good answer, everyone. I'm glad that you were able to crack this. Perfect. Clear? Clear or not? Clear? Perfect. Okay. So this was our concept of revaluation gains and losses. Revaluation gains and losses. Okay. So you can see the chart has been prepared. Treatment of revaluation gain and loss. Treatment of revaluation gain and loss. What if you revalue for the first time? What if you revalue subsequently? Can you revise it once again? It is, Baba, very simple. This example, I guess you're talking about, right? You have a loss of 100. Okay, let's say you had a loss of 100. Then you got a gain of 75. So this gain was transferred to profit and loss. Still, there is some balancing figure of loss of 25, right? Because out of this 100, only 75 is adjusted. So when again you get a gain of 30, so first up to 25, you will adjust against profit and loss. Then the balancing figure will be adjusted against OCI. Simple. Okay, done. Now we come towards this. So when you see this treatment of revaluation gain and loss, you need not read this again because we have already discussed in the notebook, right? But one important point to be seen here is whenever they have written OCI, they have used the word NR. Wherever they have written OCI, they have used the word NR. Wherever they have used the word OCI, they have used the word NR. Sir, what is this RNR? In case you remember, yesterday, one sec, I'll show it to you. When we studied under schedule 3, we studied about profit and loss and OCI. We studied about profit and loss and OCI, right? If you can see here. Under OCI, yesterday I had told you one thing, that there are two categories. OCI NR and OCI R. What is this R and R? We don't know. I had said that we will discuss in detail about R and R in Ind AS 16. The time has come, my friend. The time has come where we will cover this. What is the difference between this OCI NR and OCI R? Are you ready, guys? Absolutely ready, sir. Okay. So let's discuss about this R and NR. Okay. So where NR is written, one sec. Where NR is written, just pull a arrow down and write that we are discussing one example in notebook. Wherever NR is written, we will discuss one example in notebook. Okay. What is the difference between R and NR? Give the heading. OCI R / OCI NR. It is very simple, okay? Just try to understand the difference. First, let's write down the full form of R. What is the full form of R? R means reclassified to PNL. And what is the meaning of NR? NR means not reclassified to P&L. Now let's take one example. Let's suppose you had a PPE. Okay. At year 1 end, you performed a revaluation, you got a revaluation gain. You got a revaluation gain of, let's say, rupees 30. Such gain will be transferred to OCI. And yesterday I also discussed one more thing, that whenever you get a gain under revaluation gain, it gets accumulated in other equity also. So in other equity, it will get accumulated under the head of revaluation surplus, right? 30 rupees. Is this clear, guys? So on year 1 end, you got a revaluation gain, you transfer it to revaluation surplus. Okay, sir. Then at year 2 end, you again got a revaluation gain of, let's say, rupees 20. So we will book this in OCI again, because first time gain also and now also you are getting a gain. So this gain will be transferred to OCI. Now what will happen in other equity? What will be the balance of revaluation surplus in other equity? Just tell me this part. What will be the balance of revaluation surplus in other equity? Tell me this. Perfect answer, it will not be 20. Do you remember yesterday we discussed that in balance sheet the figures are as on date? So it will be cumulative now. 50. Perfect answer, 50. Very good. Okay, sir. Now in year 3 again, we performed a revaluation. Again we got a gain of rupees 10, which was transferred to OCI. In other equity, our revaluation surplus will now be 60, right? Cumulative. Okay, sir. Noted. Now, what happens in year 4 is, let's assume in year 4, either we sold the PP, or the useful life of PP is over. PP useful life is over. Either of the case, basically the PP is gone out of your balance sheet, right? So now what will happen with this surplus? What is to be done with surplus? Because this surplus is still existing in your other equity, right? So will it stay in this surplus balance only? No, because this other equity head denotes that it is an unrealized profit. So once your either PP is sold or the useful life is over, what is to be done with this surplus? That is to be discussed now, right? So that depends whether it was classified under OCI R when we were booking the gain. It was classified under OCI R or it was classified under OCI NR. Right? Now, if it was classified under OCI R, see what is the treatment. I will write it down first and then we will discuss the entry. Full balance of revaluation surplus will be reclassified to P&L. So what is the meaning of this line? Full balance of revaluation surplus will be reclassified to P&L. This simply means that whatever balance you have in surplus, you will remove this whole balance from this head and transfer it to profit and loss. That is what the full form of R says. Reclassify to profit and loss. You will have to remove this other equity and transfer it to profit and loss. All reserves have a credit balance. If you want to remove this balance from here, if you want to write off a reserve, you will have to debit it because it has a credit balance. You know now this basic stuffs, right? All reserves have a credit balance. If you need to empty this reserve, you have to debit it, right? So what we will say is, while passing the journal entry, what we will do is, we will say revaluation surplus. That is, the balance of your surplus will become 0 now because you are debiting it. And because the word is R denotes reclassified to P&L. So we will transfer it to P&L. 60. So if I want to give an extract in statement of profit and loss, under statement of profit and loss, how it will be shown? You will say reclassified surplus of, let's say, rupees 60 will be shown. See, the balance of surplus will now appear in profit and loss. And of course, when it appears in profit and loss, when you accumulate this in other equity, it will be transferred to retained earnings. Do you remember the balance of profit and loss used to get accumulated in retained earnings? So this is what will happen if it was classified as R. So it is very simple. You have to write off the reserve and transfer it to profit and loss, right? Because you are booking something in profit and loss, it automatically gets accumulated in retained earnings. Simple. Done. Let me discuss NR as well. What if it was a case of OCI NR, right? If it was a case of OCI NR, what is the full form of NR? NR means it will not be reclassified to PNL. It will not be reclassified to PNL. So does that mean that it will always stay under the head of reval surplus? The answer is no. Let me write it down for you. In NR, full balance of revaluation surplus will not be reclassified to PNL, will not be reclassified to PNL, but it will be directly transferred. It will be directly transferred to retained earnings. It will be directly transferred to retained earnings, right? So what does this denote? Let me pass an journal entry for you. So what this point has to say is, you will not pass the entry of surplus to PNL. You cannot reclassify it. So what entry we will pass? But we have to directly transfer to retained earnings. So we have to empty the balance of revaluation surplus. That is, our one component of other equity will become nil. And we will directly transfer it to retained earnings. So basically, if I want to show an extract of balance sheet, so how the things will be shown is, your other equity, your surplus, which was shown as 60, it will be appearing at nil now. It will become nil. And the balance of your retained earnings will increase to 60. This is what will happen in the second case. Write it down, please. Done, guys? Now, please try to understand the difference between both the methods very minutely. There is only a minor difference between both the methods. Can I say in R, ultimately the surplus is getting transferred to retained earnings. Ultimately it is getting transferred. But the only difference is, in this case, it is getting routed through profit and loss. First we book the surplus to profit and loss, and then it gets transferred to retained earnings. Right? But in the second instance, it is not routed through profit and loss. It is directly transferred within other equity. It is directly transferred from surplus to retained earnings without routing it through profit and loss. This is the only basic difference between R and NR. I hope you are able to understand this point. Tell me yes or no. Yes? So now the question arises is, sir, for PPE, which one do we opt? R or NR, or there is a choice with the company? Let's read the notes now. For PPE, what do we do? One sec. See the notes. For PP, it is clearly written that you have to follow NR. So for PP, which method we will follow? R first one, this one, or this one? No, for PP we will follow NR1. That is, for PP the routing will not be done through PNL, it will be directly transferred to other equity. That's it. Sir, who decides this? Who decides this? Whether this will go in NR or R? This has been defined by Ind AS. Of course, logics have not been specified why the Ind AS will put this in R or why they will put this in NR. Logics have not been defined everywhere, right? But you have to remember. So in respective Ind AS, we will try to remember the things. Are you getting my point? Right? So in the above table, do you remember this example treatment of revaluation gain and loss? Wherever you have written OCI, also mention NR in brackets. Wherever you have written OCI, also mention NR in brackets. So I will mention NR in brackets. Is this clear? Perfect. Also, to give you a deep understanding, let's come towards schedule 3 again. Now see, this is a statement of profit and loss. Do you remember we discussing this? Okay. Under profit and loss, you have OCI. Do you see in OCI we have A and B? See the heading of A. Items that will not be reclassified to profit and loss. And see the heading of B. Items that will be reclassified to profit and loss. Tell me one thing. Where will the revaluation gain appear? Not while the year 4 end. I am telling when you are getting that gain each year. You got the gain in year 1, you got some gain in year 2, you got some gain in year 3. So while booking the gain, where will it appear? In part A or in part B? In OCI also you have two parts now, A and B. Where will it appear? A or B? So it was clearly mentioned that whenever you have a gain, you will book in OCI NR. So whenever you are booking a gain, you will mention in part A. Correct answer. Right? So as I mentioned, whether it will appear in NR or R, it has been defined by Ind AS, right? You will have to remember this and we will study that in respective Ind AS. So for PP, we came to know that whenever we are booking the gain, it is OCI NR, right? I can prove this, whatever we studied is justified in schedule 3 as well. Just come below this format as well. You will see a list of items which appear in OCI. It has been given. What I had mentioned that we will study that in respective Ind AS. See, the A column is items that will not be reclassified to profit and loss. Items that will not be reclassified to profit and loss. See the first heading. Changes in revaluation surplus. Can you see that revaluation gain, reval surplus is appearing in NR column? This we studied in Ind AS 16. There are not many items. Hardly 5 items in NR, hardly 4-5 items in R. We will study in respective Ind AS. Also at the end of this syllabus, when full subject is over, you can also refer this as a summary. But of course, you will understand this once you have done the respective Ind AS. That is why yesterday I was saying that schedule 3, initially you can't study directly. You will have to have knowledge of the respective Ind AS. But are you able to relate with this now? Can we interlink the topics now? Yes? Yes or no, guys? Perfect, sir. Absolutely correct. Done. So this was the concept of R and NR, as well as how do we book the profits and what is the difference between R and NR, right? So for the day, we will halt here, right? I guess we have covered enough concepts for today. Would request you, when you are coming tomorrow, you have to revise it. Guys, just attending lectures or just listening to me won't help. See, it will be a waste of time for you if you're not revising on a daily basis. You have to put in that 20-25 minutes on a daily basis to revise it. If you are doing it, you will save a lot of time during your revision. You will also gain a lot of confidence from it. And that is very much required. That extra 15, 20, 30 minutes ka revision, self-revision can earn you a lot of marks and can save your attempt. So please revise, okay? But before wrapping up the session, how about we also doing one revision quickly? Okay, so let's start the quick revision in, guys. 3, 2, 1 and go. First of all, the concept which we discussed was deferred consideration. What was there in this concept? Do you remember the example? I went to Chroma shop, asked them to give MacBook. They said that if the payment is after 1 year, they will ask for interest. Such interest will not form part of the cost. Okay. Then the next point was, what if the asset is acquired by way of exchange? So do you remember, in exchange there were 3 preferences given to us, and those preferences are applicable on the outgoing asset or incoming asset. Those preferences are applicable on the incoming asset, because for the outgoing asset we will always let it go at carrying amount, right? For the incoming asset we have 3 preferences. First preference is fair value of asset given up plus cash paid if any. If this is not available, then we will use a second preference, that is fair value of asset acquired. If we don't have either of these, we will use a third preference, carrying amount of asset given up plus cash paid if any. Also, if question mentions that the transaction lacks commercial substance, this happens when you exchange the asset which are of same nature, same characteristics. So in that case you only have one preference, and that is carrying amount of asset given up plus cash paid if any, right? Do remember. Okay. Then we came towards, this was initial measurement, then we came towards subsequent measurement. In that we have 2 models, you can choose either of the models. Okay. In cost model, the method is very simple. You will keep it at cost less depreciation. In revaluation model, you will keep it at fair value. So you will have to book the revaluation gain or loss respectively. So if you are choosing for this model, you have 5 points to be discussed, out of which 4 we already covered today. First point was frequency of revaluation. If the changes in fair value happen very frequently, you will do it annually. If the changes are insignificant, you will do it every 3 to 5 years. Next point was treatment of accumulated depreciation on date of revaluation. Do you remember how many methods we have? In this we have 2 options. First one is we will eliminate it, second one we will not eliminate it. If we want to eliminate, we will pass a simple entry, accumulated depreciation to gross block, and then we will book the gain. If you don't wish to eliminate it, you will have to follow 3 steps. First, find the percentage gain. Second, apply that percentage gain upon 2 amounts, and third, pass the necessary journal entry. Simple. Done. Then after this, we also discussed that revaluation should be applied to entire class of asset. That means if you are applying revaluation to any asset, the entire class to which the asset belongs, you should follow the model to the entire class as well. Also, we discussed that office building and industrial building will be considered as separate classes. Then the next point was treatment of revaluation gain and loss. So in this we have to see whether you are doing the revaluation for the first time or not. If you are doing it for the first time, you get a gain. It will be transferred to OCI, to be precise OCI NR, right? And if you are doing the revaluation for the first time, you get a loss, transfer to profit and loss. If you are doing subsequent revaluation, you will have to check what you had previously. So now you get a gain, previously also you had a gain, so this gain will be transferred to OCI. But now if you get a gain but previously you had a loss, so first set off against the loss, and then the excess gain will be transferred to OCI, right? Now if you have a loss, previously also you had a loss, so such loss will be transferred to profit and loss. But now if you have a loss and previously you had a gain, then set off. That means to the extent of previous gain, existing loss will be transferred to OCI. Balance loss, if any, will be transferred to profit and loss. Okay, we discussed some examples also. Do revise this at home also. Then we also discussed what is the basic difference between R and NR. The only basic difference is in R. See, the initial booking during the 3 years won't matter. You will show this in OCI NR column. You will show this in OCI NR column. You will show this in OCI NR column. That is not a major concern. But when the PP is sold or the life is over, at that time the treatment will vary. If it was shown under the column of OCI R, the full balance of surplus will be reclassified to profit and loss, and then such balance will be transferred to retained earnings. That is, the routing will happen through profit and loss. But if it was OCI NR, then during the year of PP sale or the life, when the life is over, such surplus balance will be transferred directly to retained earnings, and it will not be reclassified to P&L. That is, it will not be routed through profit and loss. That's it. We are done for the day. Again, I would request you, please do revise your content. And also, if you like the content, if you are watching it recorded, do keep on passing me your feedback. Okay, you can find my Telegram ID on your Google Drive. You will have my personal Telegram ID where you can put in your comments. Okay, so just keep on passing me your feedback, whether you are liking the session or not, or whether you are able to understand things or not. Also, if you have any queries, you can let me know. Okay, so till then, thank you so much. Bye bye everyone. Take care. See you all. Bye bye. Also guys, from tomorrow, we will have the sessions only on the BB Virtuals application, right? So the demo part for YouTube is over. Okay, so tomorrow, see you on BB Virtuals application. Okay, so thank you so much. Bye bye everyone. Take care. See you all. Bye bye. Bye everyone. Bye bye. Take care. Good night.